Alrighty, welcome everybody. Today's webinar on the ultimate guide to the wheel. It's one of my favorite strategies. We're going to talk about how to do it, some tips and tricks, things to watch out for, all that sort of good stuff. So welcome everybody. Welcome Tom, who just joined. Just a quick reminder that everything discussed is for educational purposes only, is general in nature, and does not take into account your personal circumstances. All right, so a little bit about me. I know some of you we've chatted a bit on email or you've been on past webinars with me, but just a quick background. I started trading options back in 2004, made all the rookie mistakes, as you can imagine. It was a different world back then. There wasn't a lot of information online back then as there was now. It was a lot of books. There wasn't so many YouTube videos and things like that. Now it's a bit more overwhelming in some respects with the amount of information that there is out there. But yeah, started in 2004, was chasing volatile stocks, ignoring risk, trading on instinct. Had a big drop in the 2008, 2009 financial crisis. My account was a lot smaller back then, so the dollar damage wasn't as bad, which was good in a way, but, learned a lot through that. And then started Options Trading IQ in 2010. So I've been teaching other traders about options since, what is it? 2010, 15 years. So yeah, it's gone quickly. Over time, I learned the value of structure and repeatable strategies. And that's why I love the wheel trade. So learning outcomes for today, we're going to go probably about 45, 50 minutes or so. By the end of the presentation, you'll be able to understand the wheel strategy, evaluate risk and reward, identify ideal conditions and candidates for the wheel, very, very important, and learn how to manage and adjust trades with confidence. So why do we trade the wheel? Well, it's similar to a covered call strategy. Just a quick question. Is it better to have the video on or off? I know I'm covering up some of the slides there. Hopefully it's okay. And yes, it will be recorded and archived for you. In any case, I'll leave the video on, but if there's any issues, Brian says off. Yeah, maybe I'll turn it off just so you can see the whole screen. All right. So it's similar to a covered call strategy. It's a long-term strategy with monthly income. Now, some people will trade it on a short-term basis, and we'll talk about that. It's a method for buying stocks for less than what they're trading at the moment. So we can buy stocks for a discount or we generate a nice return. We do need strict trading rules as well. So here is a little flow chart on the wheel that I follow. It might look confusing at first, but once you get into it, it's fairly easy. And basically, the first thing is we need to pick a stock that we like, and we'll get into that. But say we like the stock, we want to take ownership of it, we sell a put option. We'll talk about duration, strike price, all that sort of stuff. But this is the basic flow chart. We sell the put option to start with. If the stock goes up, the put expires worthless, we keep the premium, and we can start again. If the stock goes down through the strike price at expiration, we get assigned. We have to buy 100 shares of the stock. And then from there, we can move on to phase two. At phase two, we sell a strangle. So we own 100 shares. We sell an out-of-the-money call on the upside. So that's basically a covered call. And we sell another put on the downside. We have to be willing to take ownership of another 100 shares. So from the outset, we need to plan that we might potentially get assigned 200 shares of the underlying stock. At phase two, if the stock goes up through that covered call strike, the put expires worthless, the call gets assigned, our shares get called away, and we've got a flat position again. We've collected 3 option premiums, plus any dividends that we've received through holding that stock through that time period. And we've potentially made some capital gains as well, depending on where we placed our covered call strike. If the stock goes down again at phase two, we get assigned on the second lot of 100 shares. Our call expires worthless. We now have 200 shares, and we just continue selling covered calls from there until the shares eventually get called away. Now, this is where the magic happens in stage 3, where we own 200 shares. We're collecting some really nice dividend income, and then eventually the stock rebounds, goes back up through the call strike, and it gets called away. At that point, you can see we've actually collected 5 lots of option premiums. 1 from the initial put sale, plus another 2 here from the put and the call, plus another 2 from here where we're selling 2 covered calls. So we've collected 5 premiums, we've collected dividends through this period as well, and we've potentially made some capital gains as well. Now, we will talk about strike selection, but basically, when we're selling those calls, we don't want to sell them below the price that we were assigned at. We always want to sell them above our cost basis. Otherwise, we're going to be basically selling the stock at a loss. Now, you can sometimes do that if you've generated a lot of premium and dividends. You can actually sell the stock for less than you bought it for and still make a gain. But generally, I want to sell that call above my cost basis. And if the stock's gone down a lot and I can't sell a call above the cost basis because there's not enough premium there, I basically just wait in phase 3. And sometimes I'll continue. If it's a blue chip company or an ETF that I'm trying to accumulate, I'll continue on and continue selling puts, continue dollar cost averaging into the position. Scott says, some will say sell above the price assigned, not the cost basis. Yeah, I tend to like to sell above the assigned price. That's kind of what I meant by cost basis. You've got net cost basis and gross cost basis. Net obviously is including the option premium, gross not including the option premium. I would try to sell the calls above your gross cost, basically the price that you were initially assigned at. All right, so some of the benefits of the wheel, we can dollar cost average. So we're buying shares, assets dropping. We might get assigned at 50 on the first lot, then we might get assigned at 40. Our net purchase price is 45. We're dollar cost averaging. It's an accumulation strategy. So it's more of what I would call an investing strategy rather than a trading strategy, right? So this would be something that I would do in my sort of retirement account, whereas things like condors and credit spreads, butterflies, calendars would be more of what I would call a trading strategy, where I'm sort of trading in and out, maybe a bit more short term. This is more of a long-term investing strategy. Yes, David, you have to have enough cash to cover the puts if they get assigned. Yes, so you have to budget that you might get assigned on 200 shares at the outset. Another benefit is there's consistent premium generation and also dividends while you're holding the stock. So as you can see, once we get to phase 3, we've potentially generated 5 lots of income. If those shares don't get called away, we can continue selling those covered calls and generating more and more premium. We might get up to 7, 9, 10, 11 lots of option premium on that same lot of 200 shares. It's generally considered lower risk than stock ownership because we do, rather than buying a share, buying a stock at 55 today, we might get assigned at $50 in a month's time. We've reduced our purchase price. We've basically bought it at a discount rather than going in and buying it straight away. It's very similar to stock ownership, but it is considered slightly lower risk. We do have risk on the downside. Obviously, if the stock goes to 0, we're going to lose everything, and that's not a scenario we want. And for that reason, it's really important on choosing the right type of stock. It's very systematic. As you see, it's a very easy process to follow. There is a little bit of flexibility with where you choose to sell your puts and sell your calls and the duration and things like that. But overall, it's very systematic, but also flexible. Now, some of the risks, there is obviously risks with every strategy. There is potential losses if the stock falls sharply. So this is sort of what happened to me in 2008, 2009. I was doing this on GE, believe it or not. I think it started up at about $30, and at one stage it got down to about $8. So if we go into a protracted bear market, you can still suffer, big losses. Again, that's why it's crucial to pick quality stocks that even if they do drop, they're hopefully going to bounce back. I love doing this on ETFs because generally speaking, an ETF is not going to go to 0. Right? Whereas a stock, Apple's not going to go to 0. Nvidia's not going to go to 0. I mean, never say never, right? But technically it's possible, but it's very, very unlikely. But there are some other companies that are maybe a bit more high risk, recent IPOs. Celsius, for example, had a big drop. any other high-flying stock that's fairly new, or a company that's in trouble, Intel, something like that, it's feasible that maybe that could eventually one day go bankrupt. So we want to be making sure we pick the right stocks because there are risks of loss if the stock falls sharply. It does have limited profit potential because if we sell that put, we collect the option premium. But if the stock goes on a 100% rally, we've missed out on all of that rally, right? Our only profit is the premium. So it has limited profit potential. That being said, if you do end up owning 200 shares, you can potentially not sell covered calls as well if you just want to then participate in the upside from there. That's a valid strategy as well. So you can actually structure it with a better risk profile. Now, another thing I'll do is on that example of sort of building out bigger positions, I'll show you one in a minute. I've got I think it's 1,400 shares of an ETF called EWA, the Australian ETF. And against that position, I've sold 12 covered calls. So I've still got a little bit of uncovered stock that will benefit from any upside. So you can do things like that as well. And that will change the risk profile where you do have a little bit more upside potential. It does take a large capital requirement, as David touched on. It's not really a strategy for people with small accounts, right? Because if I'm going to buy 200 shares of NVIDIA through this wheel process, I might get assigned at 170. That's $17,000. Maybe the next lot gets assigned at 160. That's another $16,000. We're talking about $33,000 that you have to come up with for that one stock, that one strategy. So it does take a lot of capital. If you've got a small account, sort of $20,000 or less, you're better off looking at credit spreads and things like that. So choosing the right stocks, as I've sort of touched on, this is ultra important. Now, everybody's different. Everybody's got different goals. They're at different age, different risk profile, all that sort of stuff. But for me, I really like large cap blue chip stocks. Again, stocks that are not going to go to zero or very unlikely to go to zero. Stocks where I'm really happy to buy the dip. If it drops, 10%, I'm happy to buy. If it drops another 10%, I'm happy to buy another 100 shares because I know that generally speaking, those blue chip shares are going to recover. They also tend to pay a pretty decent dividend if I am stuck holding them for a while. And again, usually for me, this is an accumulation strategy. So a lot of times once I've bought them, I actually don't want to sell them. I actually just want to hold them for the next 10, 20, 30 years, right? So I'm looking at blue chip stocks, quality ETFs. And I say quality because I wouldn't recommend doing this on, 3 times leveraged ETFs, high risk ETFs on different high risk underlyings. Think about if you've got enough capital, obviously, SPY, QQQ, what else? And any of the sector ETFs, XLY, XLU, IYR. I really like country ETFs as well. So I touched on EWA, the Australian ETF. EWU is a British ETF, EWG, Germany, all that sort of stuff. EEM is an emerging markets ETF. EWZ, the Brazilian ETF, a little bit higher risk, but I like doing those ones as well. So quality ETFs. Good question from David. Do I ever roll puts so they don't get assigned? Yes, I will do that sometimes. If I want to delay assignment or I'm not quite ready to take assignment, I will definitely roll at times, and I'll show you how to do that. Another type of stock I'll look for is one with a good dividend history. So think about dividend kings, dividend aristocrats, stocks with a really good history of paying good dividends. Now, I've got their high volatility stocks. What do you think? Are they a good option? Are they a good candidate for the wheel? And the answer is maybe, right? It really depends on your risk profile. You might be a really high risk investor, high risk trader, in which case high volatility stocks might be okay. MSTR, any of these recent IPO stocks. The difference with high volatility stocks is you might have to be prepared and aware that they could drop 60, 70%. Even quality companies like I think Shopify in the last couple of years had like a 60% drawdown. Um, Amazon, when it was a newer company 15, 20 years ago, had about an 80% drawdown, right? So I'm not saying don't do them on high volatility stocks, but just be aware of the risks and be aware of the fact that it could drop 30, 40% potentially. All right, choosing the right strike price and days to expiration, also very important. Personally, again, this is personal preference. I'm looking around that delta 25 to 35. It has a good balance of reward and risk. And we can use delta as a rough estimate of probability of being assigned. So a 25 delta put has a roughly 25% chance of being assigned, of going in the money. 35 delta put, a little bit closer into the stock price, we're going to get more premium, but we've got a 35% chance of it getting assigned. Again, you might be a bit different. You might want to take a bit more risk. You might want to be closer to at the money, or you might be the opposite end and you might want to go really far out of the money, accept a lower return, but have a much lower probability that the stock will be assigned. In terms of days to expiration, DTE, 30 to 45 days is a really good sweet spot. Okay. Now, there is a difference between short term and long term, and it's all about finding a balance and something that will work for you. As I said, everybody's different. I actually like slightly longer term trades. For me, I want things that are quite slow moving. I don't want to be monitoring everything like a hawk. I don't want to be stuck in front of a screen. And also with being based in Melbourne, Australia, the time difference, if I'm trading US options, the market's open 11:30 p.m. till 6 a.m. It's very difficult to trade. I don't want to be trading every day. I want to be monitoring this stuff once a week. So I'll be more in that 90-day range for a lot of trades, even out to sort of 120 days. Whereas if you're a more active trader and you have more time with family, job commitments, all that sort of stuff, you might prefer to do kind of weekly trades. Now, a 7-day trade, and we'll look at this in a second, is going to give you the highest annualized return percentage. But it's also going to be the most amount of work because you're going to have to be rolling or adjusting or taking ownership every week or so on these trades. As I said, 30 to 45 days, a really good middle ground, good sweet spot. Some people will prefer longer term like me. Other people will prefer to be shorter term. JB says, is implied volatility important for premium? Well, the premium is all based on implied volatility, basically. High volatility, you're going to get high premiums, but you've also got high risk. Low volatility, you're going to have lower premiums, lower annualized return, but also lower risk. And again, it's all personal preference. All right, let's take a look at some examples. We've gone through a little bit of theory. Let's get into the nitty-gritty. Now, I like to use interactive brokers to demonstrate these trades. This is called Risk Navigator. If you need help with this, I've got some videos you can watch. If you use a different broker, a lot of people use Thinkorswim. They have the Analyze tab. It's going to be pretty similar. Tastytrade has something similar. Most brokers are going to have something similar, but we always want to evaluate our trades. Now, before I get into an actual trade, let's go and look at, I've got a stock screener here that is going to show me stocks that are reporting, large cap stocks with good option volume that are reporting earnings in the next couple of weeks. Because we're going to compare some sort of extreme examples so that you can kind of see the difference. Now we've got Apple reporting earnings this week. The IV percentile is quite high. Now I could do a whole 1 or 2 lessons just on implied volatility, but basically, as JB touched on, we go over here to volatility charts. The option premium is all based on the volatility. Because Apple's reporting earnings this week, it's got very, very high volatility in the front week. So there's going to be very high option premiums here. Okay. Whereas if we're going longer term, the volatility is a lot lower. Now the premium, the actual premium might be higher, but the annualized return is going to be lower. So we can use earnings to our advantage if we like the company. Let's say we wanted to do this on Apple. It's actually a great time to do it with earnings this week. We could actually do a weekly trade. There's our 23 delta. Let's go to the 32 delta at 210. If we were to sell that option, we'd receive about 265, 270 in option premium. And let's look at our payoff graph. Now, it doesn't look very attractive when you look at it like that. We've obviously got 21,000 roughly of risk if it goes to zero, but that's unlikely. So we're just going to zoom into this sort of area here. We can see our maximum profit is that premium received 260, 270. Our break-even price is down here just above 207. And this is our T plus zero line. It looks a bit off actually. It could be because it's a Sunday and we're after hours. Normally this would be down here at the zero line. But in any case, I have a little calculator that I use to evaluate these trades. I'm just going to try and bring this over and see if we can view everything at the same time. So all you need to do with this calculator, a lot of you will already have this. If you don't, just shoot me an email. I can give you a copy and I'll add it into the email or the replay. All we need to do is update these green cells. So the expiration date is August the 1st. Very short-term trade, 5 DTE. Stock price is 214.71. Our strike price is 210 and the premium, let's say 270. The numbers I'm interested in are sort of these ones here. If the put expires worthless, we're going to get about a 1.3% return in a week, which is pretty good, right? That works out at a 95% annualized return, which is amazing, right? And that's because of that high volatility around earnings. You can see here, Apple generally has IV of about 27.8, but the IV on this particular option is 37.7 because it's highly exposed to that earnings announcement. Now let's compare that with a longer term one, and we'll try and keep it as similar as we can in terms of our delta. Let's say October, that's around that 80 DTE. And if we've got something around a 32 delta, there we go, we do. You can see there we're getting a lot more premium. Let's change our risk graph here. Ooh, now we're getting $615 in premium. Our break-even price is all the way down at 199. Let's compare that in our little calculator here. Let me just bring this over a little bit more. So our expiration date in this case, 10/17. Stock price is the same. Strike price is a little bit lower and our premium's way higher. So now we're generating a lot of option premium, right? But it's 82 DTE. We're getting a 3% return, but on an annualized basis, it's only 13%. But we do have a much bigger decrease to our break-even price. So it's all about comparing the options, the strategies, and finding something that works for you. Now, it is quite attractive to do this before earnings, but there's also risk that the stock could have a big drop. But if you want to get the highest return, this is the way to go. If you want a more slow-moving return, slow-moving trade, and don't get me wrong, 13, 14% annualized return is still pretty good, right? I'd be pretty happy with a 14% annualized return with a 7% margin for error. So it's all about finding a style that works for you. You can kind of see here now the volatility here is 26, so that's impacting our annualized return as well. The volatility is lower, the days to expiration is longer, but the trade's going to be a lot more slower moving and it's going to be a lot less impacted by earnings. So that's one example. What about if we look at a really low risk underlying? Now, this is not going to be for everyone because it's very, very low return, very sort of boring trade. But this is one that I actually put on this week or last week. And you'll see that the actual return isn't overly impressive. Let's change our dates here. So I sold a few of those, but we'll just do one contract to keep it simple. And let's go zoom in here. All right, so you remember these numbers. Let's update this with the XLU example, very, very low beta ETF. It's the utilities ETF, doesn't really move that much at all. 145 DTE and getting about 180. We've got a 5% margin for error, 5.6% annualized return. Not overly impressive, is it? But this is more suits my style because I'm pretty low risk and I want slow moving trades. So I'm happy with this. The other thing to consider as well, we need about $8,000 to potentially take assignment of the shares, right? 8,200 less the option premium. I'll take that 8,200 and I'll leave it sitting in a high yield savings account or my mortgage offset account, right? So on that cash that's sitting there waiting to be utilized for this trade, I'm actually getting about, say, 6% on that cash because it's offsetting my mortgage. That actually brings that underlying return up to about 11% for the year, right? So that's actually now fairly impressive for a pretty low risk underlying. So that's another example of the sort of thing that I'll look at. And then if it goes below 82, I'll take ownership. I'll potentially sell another put down at 80 or 78, and I'll just keep building that position, collecting the dividends, selling calls up above 82. What would be the high yield fund or account? It depends on your country, but in Australia we've got ING. They pay maybe 4.5% interest. As I said, I've got mine in my offset accounts. You can use T-bills. You can actually buy T-bills or an ETF called SHV for the US, which is a sort of a T-bill ETF, pays about a 4.5% dividend. Yep, there's plenty of different options. Macquarie Bank in Australia pays a good, I think, 4.8% introductory rate or something I heard on the radio. So pretty easy to get sort of a 4 to 4.5% return on your idle cash while you're waiting to get assigned. All right, let's go to the opposite end of the spectrum and look at a really high risk underlying. Got a couple of ideas here, but let's use our scanner and we'll try and find something with implied volatility. I'm going to take off the earnings and I want something with implied volatility greater than 60%. So let's see. We've got a few good names here, nice high volatility. A couple of examples here. They're quite high price stocks, but let's use this one, CoreWeave. This is one of the ones that I wouldn't do personally, but I'm going to use it as an example because it's kind of an extreme example. I think this is a fairly recent IPO stock. And it's got earnings, so that's good. But yeah, look at that. Not a great chart. But anyway, ignore the chart. We're basically just looking at the IV. Look at that, 107% IV. The IV percentile and IV rank is actually a little bit low, but that's okay. But this, you're going to see some impressive numbers here now, right, compared to XLU. What was the earnings day? About August 6th, I think. All right, so now where's our 35 delta or 32 delta? 110, that's a good one. So if we sell that one, we're on the hook to buy the shares at 110. Currently trading at 118. We're going to get about $526 in premium. All right. Still got a roughly 32% chance that it's going to get assigned. Let's leave this one here and let's compare this one. Stock's at 118.20. This is at 110 and we're getting, say, 525. Look at that, 152% annualized return with an 11% margin for error or decrease to our break even. Massive return compared to this, right? Now, I'm not saying this one's better than this one because the return's higher. It's all about risk. What risk do you want to take? Are you a high risk trader that is comfortable with a stock like this, or are you a low risk trader and you want to look at these ones? I'm not saying this one's better because it's lower risk and this one's worse because it's high risk. I'm not saying this one's better because it's high return. It's all about finding a balance and finding something that works for you as an individual. Personally, I wouldn't touch this one. Too risky for me. But if you're a high risk trader, the returns are there. If you believe in the company, that's the key as well, right? You don't want to get stuck holding this if it's a, you know, terrible company and you buy 100 shares at 110, you maybe buy another 100 at 90 or 100, and then all of a sudden the stock goes down to 20, which is feasible with a stock like this, right? Whereas XLU is unlikely to go down to 20, right? So it's all about finding that balance. Does anybody have any other examples that they want to look at? Philip says, do I always let the trades expire? Not always. So let's look at an example, XLU with this longer term one. Let's say the underlying increases quite a bit, and then this option goes down to about 10 or 20 cents. At that point, I'd probably buy it back and maybe look to resell another put or move to a different underlying. So I'll do things like that. I'll also roll, as someone mentioned earlier. Let's say, XLU drops down to sort of 82 and a half, and I think, oh, I don't really want to take ownership of this yet. I prefer to leave that money sitting in the offset account for a bit longer. I'll roll out in time and potentially down in the strike price. Yeah, we've got a couple of good examples. Gary says, what's the denominator of the return margin requirement or buying power? The denominator is the full capital at risk, so not the margin. I always use that based on the fact that I might get assigned. All right, let's have a look at Snap. Yeah, JB, I love Aussie stocks. They're more in the low return category, but yeah, BHP, all sorts. BHP, NAB, Commonwealth Bank, Wesfarmers. All right, so we're looking at Snap, August 15th. This is a really low priced underlying. Again, probably not one that I would do, but generating $55, $60 in premium. So you could potentially do a few contracts on this one. But just in terms of the pure numbers, 9.55. Again, really high return, nice margin for error, but it's a high risk, high underlying stock. Yeah, MSTR is another one in that sort of high risk category. And this is a bit of an unrealistic example because it's such a high priced stock. You'd need, $40,000 just to do one contract, potentially $80,000 to do two contracts. Where's our 32 delta? We'll say 30 delta at 385. So good extreme examples here on these high volatility stocks. It's actually pretty low volatility for this particular stock, but we're getting $1,000 in premium, and we're on the hook at 385. Pretty high annualized return. I'd say for me that's not quite high enough for the risk of this underlying, but a pretty decent decrease to our break even. I wouldn't look at leveraged ETFs. SPY, QQQ, obviously good examples as well. Aldo says, on the higher risk stock, why take the 32 delta for 154%? Maybe look at a lower delta and still perhaps 60% annualized. Yeah, absolutely. You could. That's the other example that we can look at. This one isn't quite as high. What was the other one? CoreWeave. That was probably a better example. So rather than the 32 delta, we go all the way down to sort of a 10 delta. Let's say a 12 delta here at 100. And let's compare them both. So the first one was 110, we got 525. The next one is at 100 and we're getting 185. So yeah, here you're getting a 17% margin for error and still a 57% annualized return. So, that might be a good option if you're willing to take ownership at 100. Again, I think you've got to be prepared for the possibility that this thing could go to 50 or 40, even 20, right? Because it's a high vol, meme stock, exactly as someone said. Gary asks, is the IV of the stock some blended average of different strike DTE? Yes, exactly. 100%. Yeah, and then each individual strike has its own IV. Like I said, I could talk probably a whole hour or two just on volatility, but um, mainly just looking at the wheel today. So anyway, lots of different examples, different strategies of how to do it. I've got a wheel tracking spreadsheet as well. If you want to get a copy of this, or you don't, some of you will already have it. So this is that trade on EWA that I was talking about. Started this a couple of years ago. Stock's up 10%. This trade's up about 28%. So that's the power of the wheel. Collecting lots of dividends. You see every 6 months getting $550, $600 in dividends. Lots of option premium. So if you want a copy of this spreadsheet, it's pretty easy to update. Everything's sort of pre-populated. Then we can say, sell to open, cash secured put, blah, 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 and then you just fill it in like that. Pretty straightforward. But if you've got any questions on that, just let me know. Couple of questions here. Is there anything you use to determine the timing of when you want to sell cash secured puts, covered calls, technical analysis? Yeah, absolutely. You can look at technical analysis. Again, I could probably spend an hour on that, but just simply looking at support, resistance, moving averages, that sort of stuff. Paul says, do I ever protect the downside? Yes, I will do things like buying put spreads, diagonals, etc. Philip says, do you study fundamentals to pick good stocks to wheel in inverted commas? Yeah, I tend to be a bit more of a technical trader, but for sure, when you're looking at this strategy, you want to be looking at the fundamentals as well. You want to have a company with good earnings. Whereas some of these new IPO stocks, I'm not sure about CoreWeave, but some of them have negative earnings, right? And it's all based on the potential growth. Whereas personally, I'd prefer to, look for a solid company with positive earnings. I'd be looking at an Apple rather than a CoreWeave, for example. And as I said, ETFs, you can see here, I'm a big fan of ETFs. Started one recently on the Bitcoin ETF. Happy to take a little bit of exposure to Bitcoin. So yeah, mostly ETFs on the US at the moment. I'll probably might do some Nvidia. Started an Nvidia one pre-earnings, and then these are some of the Aussie stocks that I'm doing as well. So for example, NAB stock's down about 4%. I'm up about 2.5%. Not a great return so far, but the stock sort of went through a pretty big drawdown and is now just sort of recovering. BHP's one that's been going for just under a year. The stock's basically flat, and I'm up about 6%. Took assignment at 38. Sold some puts down at 37.50. I'll buy some more at 37.50, and these will get potentially called away at 38. The other thing I'll do, if I've got a covered call that goes in the money, and I actually want to hold on to the stocks, I'll buy that call back at a loss and resell the call at a higher strike. Because I actually don't really want to get rid of these BHP shares, and also these EWA. These are sort of a long-term position for me that's building my dividend income. Whereas this one as well, the covered calls at 25, the stock's at 26.48, slightly in the money. So I'll have to buy that back at some point before expiration and look to resell. So there's a little bit of an introduction to the wheel. Hopefully you've learned a few things. Let me know in the chat if you've picked up a few tips here. But some of the key takeaways from today's session. So the first step in the wheel is we sell a cash secured put to buy a stock at a discount or potentially generate that nice annualized return. Once we're assigned, we sell covered calls to earn income while holding the stock and collecting dividends. repeat the cycle for systematic premium generation. And we also get steady income from the option premium and dividends. So it's really an income focused strategy where we're less aiming for huge capital gains. Okay, it's more of an income strategy. So it's great for when the market's sort of consolidating and going sideways. It's going to underperform when the market goes on a massive bull run because we don't get a lot of that upside. But it's going to outperform if the market goes down or is sideways. And it's a strategic way to accumulate quality assets over time. So this is my favorite way to use it. Just continue to buy those quality assets, increase my annual dividend income in my retirement account. I've got a repeat of the slide there. Sorry about that. So thanks for joining. Thanks, Jim. I'm glad you enjoyed. Thanks, Tom. If you've got any questions, feel free to reach out. Thanks, Robert. Thanks, Harinder. Thanks, Gary. Yeah, I'll send the replay out and I'll provide links to the wheel template and the cash secured put Excel calculator as well if you don't have them already. Thanks, JB. Thanks, Paul. Thanks, Shelley. Nice to see you here, Shelley. And JB as well, and Scott, Marley, Philip, John. Awesome. Thank you, everyone. Thanks for attending. Thanks, Brian. Thanks, Kieran. Thanks, TM. Thanks, Aldo. Thanks, David. Yeah, like I said, feel free to reach out anytime. There's only so much I can get through in a sort of 45-minute session. But if you have further questions that you didn't get a chance to ask today, or things that you think of later, please just shoot me an email. All right. Have a great day or a great evening if you're in the US, and I'll talk to you soon.